Welcome back. Let's get to our calls of the day. First up, Colgate-Palmolive downgraded to underweight at Wells Fargo. That's an unusual call for this stock. Jason, you own this one.
Listen, I mean, Colgate's been a juggernaut this year. It's up 32%. This is a completely a valuation call. It's trading at 29 times forward. It's a staple stock, so they're looking at growth going forward. I think they've done a really good job about optimizing operational expenses and really managing execution. 60 straight years of dividend growth. So for me, and they're also continuing to grow in Latin America. So again, valuation call for me. I could see that with the stock moving as much as it has, but we're going to keep holding it here and not move anything.
You said there's growth. It's like 2% revenue growth, Jason.
It is.
You're paying 29 times forward for 2% revenue growth.
Yes.
And you're happy with that.
Yeah. What I would say to you about that is we're going through an easing cycle. So there's a 2% dividend yield. So I think staples get more value in that type of environment. So that was one of the reasons why we held it. And obviously what they're doing in optimizing their business and the multiple streams is the reason why we selected it.
Yeah, they may get to 2.5% revenue growth at some point.
I mean, that would be real growth. That would be real growth. I mean, but Colgate is not alone. Coca-Cola. I mean, there are a host of companies at new highs with these dividend yields, but a single-digit revenue growth. Anastasia.
Yeah, and I think the reason for that is because it's more about valuations and what do you do, what stocks, what sectors do you hide in if you're unsure about the economy. And we know, looking at the data, that defensives like staples, like utilities, tend to outperform in the 6 months after the first rate cut. So I'm not surprised they have a little bit of a higher valuation. I think you might want to stick with that.
All right. Next up, Oracle upgraded to a buy from a hold at Melius. Joe owns it. So you like this?
Well, the street asked the company to prove itself in the conversation with other AI cloud companies. And that's exactly what this firm has done. It's up 22% so far month to date. The street is just warming up to it. It's got 63% of the analysts have a buy rating. The other cloud names, the Amazons, the Microsofts, they're in the 90s. So there's more room for upside potential as it relates to sentiment from the analyst community. And they're proving themselves. They're delivering on the earnings. And I believe the stock, it's reasonably valued. And I think there's a lot of room for it to run towards 200 and maybe beyond.
I think what was really pivotal on that earnings call is when Safra Katz was talking about how nobody was going to give up their Oracle databases. So all these cloud providers are starting to realize that. So they're starting to partner up. So they announced a partnership with Amazon Cloud last week. Larry Ellison was very, very bullish about AI spend for the next 5 to 10 years being very strong. Jason, you own this. And I'd like to point out that this is trading at 26 times forward versus your Colgate-Palmolive trading at 29 times forward. But anyway, you own this one and you like this.
Yeah, just a little bit different companies, right? 17% EPS growth, 7% revenue growth. Their guidance was really strong on the call. And to Joe's point, there's unlimited demand for their cloud business. And to your point as well, I mean, the partnerships, they continue to partner with new folks. So they're no longer kind of competing. They're doing the partnership strategy, which I think makes a lot of sense for the company.
Yeah. How are you feeling about Oracle in the AI sort of?
I just think, I keep waiting for pull back. It doesn't. And when it did, I guess I was out of the office because I didn't buy it, but I'd like it pulled back again. Quarterly reporting has been uneven with this company, which is not unusual, not criticism on them. It has to do with their end markets when they decide to commit. But I like it. They are in the sweet spot. I wouldn't say they've been ignored, but 7% revenue growth, when you got the revenue growth of the other Mag 7, that's sort of a lot lower, except for Apple, which goes through 2-year periods where they have no revenue growth. So bottom line is, I like it. I'm going to keep waiting for that opportunity. May never own it.
All right, let's get to Progressive. Reiterated overweight at Morgan Stanley. Price target goes to 300 from 260. Joe's in this one, insurance name.
One of the better holdings that we have in the Joe T strategy for the financial sector, up 62% over the last 52 weeks. And they really are in the sweet spot when you're thinking about pricing power and the effect of inflation. Certainly, we all know the cost is for auto insurance. But what they're doing is they're increasing the underwriting standards and maintaining revenue growth, which is remarkable. And they're also seeing significant penetration in market share. The analyst community expecting by 2028 this is a company that can approach 20% of the auto insurance industry overall market share. So very strong holding. It's not going anywhere anytime soon out of the portfolio, that's for sure. And it's certainly a company that has strong tailwinds in the insurance industry.
All right. Finally, ExxonMobil price target raised to 130 over at Mizuho. Joe, you own this name specifically.
So the interesting conversation with ExxonMobil is why ExxonMobil is performing so well and why is Chevron struggling. Now, some of that is related to Guyana and the potential production increases that they're going to get as a beneficiary on the recent transaction that ExxonMobil has done. But I look at energy right now. I see a lot of volatility. It seems to be going to a lot of different places and ending up between the $65 to $85 range that Mark Fisher has come on air and identified as where crude oil is probably going to be trading and has been trading. And in that type of environment, ExxonMobil is going to give you the exposure that you need to energy equities, not relying on the beta element of I need price to move towards $100 for my energy holding to work. And a lot of ownership in energy equities is about, okay, what's my beta exposure? How can I capture that beta in where the price of oil is ultimately going? You don't need that with ExxonMobil. So I think the viewers are served well to look at this company, find some ownership there. And then for those that are in Chevron, I think you really have to ask yourself the question, are you in the right place? And why is Chevron struggling relative to Exxon?
Yeah, so Melissa, energy for me has been a market weight sector at best for a long time. And the reason is because everybody agrees there's too much supply, whether it's from non-OPEC or potentially from OPEC as well. But now when I look at it, I think what's happened in the recent weeks is as investors started to fret the fear of recession, they started to bake that into the price of oil. Everybody knows there's a lot of supply, but now I think there's some concern about the demand. And if you think we are still headed for a soft landing, and if you do worry about geopolitics, I think energy may be just a call option that you buy for that.